Welcome to the Real Life Curriculum, where we teach you the things that school should have. Today we're talking about how banks make money off of you. I am by no means an expert, so please feel free to cross-reference, double-check anything you need to validate the things that I say in these videos. Let me start off here with a quick story first. So a few years ago, a woman walked into her bank, and she asked them why she was charged 8 overdraft fees in a single day. She said she only made one purchase, a cup of coffee. The bank's answer? Oh, we recorded your transactions. Meaning they processed the largest ones first, so her account would hit zero faster, triggering fee after fee after fee. That one cup of coffee cost her over $200 in the end. That's when it hit me, yo. Banks don't just store your money. They study your behavior. They understand your weaknesses, and then they profit from them quietly, daily, automatically. But once you understand how the system works, you'll never look at your bank the same way again. So let's dive right in with number 1, and that's fractional reserve lending. How banks create money out of basically thin air. Most people think banks make money the same way that we do, by earning it. But nah, banks don't. They have a cheat code. Imagine, you give me one sandwich, and somehow I loan out 9 sandwiches to other people, all based on the one that you gave me. That's fractional reserve banking. When you deposit $1,000, the bank is required to keep only about a fraction of it, maybe 10% on hand. The rest is turned into loans. Those loans get spent, and the money gets deposited again, and then loaned out again. Your original $1,000 becomes multiple streams of money that the bank earns interest on. Your deposit is like planting one seed and the bank harvests an entire forest. Dang. You supply the raw material, and the bank multiplies it. Ain't that some spit? Number 2 is the interest rate spread. The oldest trick in banking, actually. Here's the simplest metaphor in this whole video. Banks are stores that sell money. They buy it cheaply from you, sell it expensively to someone else. Your savings account might pay you 0.01% interest, basically pennies on the dollar, but the bank charges 5% for a car loan, 6 to 7% for mortgages, 15 to 30% for credit cards. The difference there, that spread, that's pure profit, man, and it's crazy. It's like buying water for a penny a gallon and then selling it for $5 a gallon. Phew. Number 3 is fees, the silent billion-dollar trap. Bank fees are like mosquito bites, tiny and annoying. And if you get enough of them, they drain you. Overdraft fees, maintenance fees, transfer fees, convenience fees, inconvenience fees. Yeah, some banks literally call them that. One man found out that his bank processed transactions from highest to lowest, even though he made the smallest ones first. Why? Because hitting zero earlier triggers more overdraft fees. Many banks have been fined hundreds of millions of dollars for this exact behavior, and yet the tactic quietly continues. Bank fees are booby traps. You don't see them until you step on one. Number 4, credit cards, man. Credit cards are like the crown jewel of banking profits. Credit cards are the single most profitable consumer product ever invented. Why? Because the system is designed for you to carry a balance for as long as possible. If you owe $2,000 at 22% interest and make only the minimum payments, it can take you more than a decade to pay it off, and you might pay more in interest than the original purchase itself. Banks deliberately set minimum payments low so your balance never really disappears, and even if you never pay any interest whatsoever, they still make money every time you swipe the card. A credit card is bank charging rent on your past decisions. Number 5, we got loans. The long-term money-making wealth machine. Loans are where banks play the long game. Mortgages, student loans, auto loans, these are multi-year, sometimes multi-decade streams of predictable profit. A standard 30-year mortgage, you might pay 50 to 100% of the home's price again just in interest. A $300,000 house might cost you $450,000 to $600,000 by the time you're done. A long-term loan is a slow drip faucet, except the water is your money, and the bank installed the faucet. Number 6, investments you never see. Banks don't just make money from loans and fees. They also invest your deposits. Government bonds, corporate debt, securities, sometimes even risky assets. If their investment do well, the bank wins big. If they don't, your interest rate doesn't magically just rise to compensate what you lost. Nah, your money is a worker bee. The bank sends it out to collect honey, and you get a teaspoon of honey while they keep the whole hive. And then 7, we got hidden terms, and I'm sure y'all know about terms and conditions. Confusion as a business strategy. Bank contracts are the longest, driest, most unreadable documents most people ever sign, and that is not by accident. Hidden inside are clauses that can raise your interest rates, trigger new fees, change terms after the fact, penalize late payments, and restrict withdrawals. Banks understand psychology. Most people won't read 20 pages of fine print. The fine print is a trap door. You don't notice it until you're falling through. So, as a counterplay, how do we beat this system? I'll tell you right now. Here's how you play the game smarter. Number 1, you don't keep large amounts in low interest accounts. Let your money grow. Don't let the bank harvest it. Number 2, pay credit cards in full every month. Interest is the trap. Avoid the trap. Number 3, use high yield savings or credit unions. Smaller institutions often give better terms. Number 4, read loan terms slowly. Confusion is their weapon. Clarity is yours. Number 5, invest consistently. Your money should work for you, not them. Look, banks aren't villains, but they are businesses. And the less you understand about money, the more profitable you become to them. But now that you see how the system works, you're no longer the target. You have now become the exception. If you want more deep breakdowns like this, hit subscribe, and I'll see you on the next one. One last thing, did you know a majority of money in the economy is not cash? Nah, it's digital credit created by banks. Some banks have generated over half of their consumer revenue from fees alone. Credit card companies design reward systems knowing people will overspend to earn points. Banks use algorithms to predict which customers are most likely to pay fees and target them with product offers. In some years, banks made more from overdraft fees than from actual checking account services. Now, if you can still trust the bank after all that, there's no hope left for you.